All right, hello and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each of these. Nothing that we mention in this podcast should be taken as investment advice. James or I could have positions in any of the stocks that we mention in this podcast, and we reserve the right to change those positions at any time, with or without notice. So make sure you do your own work and consult with a professional before making any investment decision. With that being said, the topic of today's podcast is going to be Bitcoin mining. Now, we've talked about Bitcoin mining before and why we think that the Bitcoin mining industry is unfavorable in general. But in the past few months, there have been several significant updates in the industry, those being the Bitcoin halving from earlier this year, and also the price of Bitcoin being basically at all-time highs right now. So we're going to get into those updates and see whether or not we need to update our perceptions of the Bitcoin mining industry as a result. Now, just a quick recap of Bitcoin mining in general for those who may not be as caught up on the story. We view Bitcoin mining as a structurally unprofitable business model. And the reason we think that is essentially three different reasons. So the first reason is that the revenue per block mined of Bitcoin by the Bitcoin miners is perpetually decreasing at an exponential rate. And that's due to the Bitcoin halvings. The second reason is the cost of electricity. So cost of electricity to run the mining rigs is very, very significant, and it's a variable cost that scales with the amount of Bitcoin that's mined. And finally, we have perhaps the biggest one, which is capital costs, the cost of the mining rigs themselves being an extremely high proportion of the revenue made by the miners, and also perpetually being needed to be replaced with the newer and most advanced mining rigs. And because of these reasons, we've seen that no major, at least publicly traded Bitcoin miner is profitable in the United States. So the first reason, the revenue per block, the revenue that these Bitcoin miners earn per block mined decreasing perpetually. As you may know, the majority of miners' revenue comes from block rewards, which basically means for every block that's mined, the miners get a certain amount of Bitcoin. And every 4 years, that amount of Bitcoin gets cut in half. So the most recent halving was earlier this year, just a few months ago, when the amount of Bitcoin rewards got cut in half from 6.25 to about 3 Bitcoins per block. And so it's always a bad thing if nothing else changes except your revenue per unit of operations gets cut in half. And finally, we have the capital expenditures, which is probably the biggest expense. The mining rigs that the miners use to mine the actual Bitcoins are application-specific integrated circuits that are basically useful for nothing except for Bitcoin mining. These devices are very expensive, and because the technology is advancing very, very quickly, old rigs that are more than about 3 years old are no longer efficient enough to keep up with the newer rigs, and so they have to be thrown away and sold as scrap metal, and new ones have to be bought. So this constant expenditure of having to replace old rigs with expensive newer rigs is a major cost for the Bitcoin miners. And finally, just to give a sense of the profitability of the Bitcoin miners, if we look at four of the most major Bitcoin miners in the U.S. today, as you can see here, I just took the 2023 revenue and income. Now I adjusted the net income to exclude the change in value of Bitcoins that these miners hold, because the value of Bitcoin increased so much in the past year. We do this because when looking at a Bitcoin miner, we're really interested in the profitability of the mining operation itself. If you care about the gains on the price of Bitcoin, you might as well just buy Bitcoin directly. So if we exclude the change in value of the Bitcoin itself held by the miners, all four of these Bitcoin miners are significantly unprofitable, at least in 2023. So with all that recap of the Bitcoin mining, I'll hand it over to you, James, to talk about the more recent developments in the Bitcoin mining industry.
Before we move on with the rest of the video, just a quick pause to tell you all about our website, differentiatedanalytics.com, which provides professional grade short selling research that we create when we identify companies that we believe to be either fraudulent or overvalued, and we write very detailed original research reports about them. So if this is something that you think might be of interest to you, make sure to check out our website, differentiatedanalytics.com, or click the link in the description below. So with that out of the way, we'll get into the main topic of today's video. So Ryan just gave you an overview of the Bitcoin mining industry, and I will be talking specifically about one Bitcoin miner, Riot Platforms. And the reason I'm talking about them is purely because they just released their earnings report yesterday, and they, I believe, are the first of the major Bitcoin miners to release Q2 earnings. So by analyzing Q2 earnings, we can get a sense of what impact the halving will have on profitability, because the halving happened in April, which was in the middle of Q2. So by analyzing the Q2 earnings, we can get a sense of what impact the halving is going to have on the profitability of Bitcoin miners. So as Ryan alluded to earlier, as Bitcoin mining rigs become more efficient over time, the Bitcoin miners upgrade their rigs and are able to supply more computing power onto the network. The computing power is called hash rate. So as the total amount of hash rate in the world increases, it becomes more and more competitive. And for each individual Bitcoin miner that has a given amount of hash rate, if the global hash rate increases, you'll get less Bitcoin per hash rate that you have, because you're competing with a wider pool of other miners. So the global hash rate is highly correlated with the difficulty rate of being able to mine Bitcoins. Now, one of the things that a lot of the bulls were saying, so people who were bullish on Bitcoin mining stocks, prior to going into the halving event, a lot of the bullish analysts were saying, well, it is true that the industry's revenue in terms of Bitcoin is going to be cut in half overnight with the halving event, but this will be partially offset by the fact that a lot of the inefficient miners will be forced to exit the market, or at least scale down their operations. And this will cause a decrease in network hash rate and a decrease in competitiveness, which will make it a little bit easier for the miners who remain. While this did indeed happen to some extent, and the global network hash rate indeed decreased a little bit up until about mid-July. But over the past couple weeks, network hash rate has been increasing again and is now pretty much back at the all-time highs. So it was true that some of the less efficient Bitcoin miners indeed exited the market or scaled down operations. The long-term trend of mining rigs becoming more efficient, and therefore the amount of computing power increasing, that long-term trend is still happening. And that has created a situation where the network hash rate is now at an all-time high and is probably going to continue increasing from here. So with the network hash rate being pretty much at an all-time high, and the fact that block rewards were cut in half as a result of the halving, the amount of revenue that Bitcoin miners are generating per a given amount of hash rate that they operate has been cut in half. So if you are a Bitcoin miner with say you're a Bitcoin miner with a fixed operation, a fixed amount of mining rigs and computing power, your revenue in terms of Bitcoin has been cut in half since the halving event. And if we look at it denominated in US dollars, revenue has also been roughly cut in half, because the Bitcoin price is roughly stayed flat since the halving. So industry-wide revenue has been cut in half as a result of the halving event. So what does this mean for profitability? So looking at Riot blockchain, or Riot platforms, as they now call themselves, in the second quarter, they claimed that their direct cost to mine each Bitcoin was $25,000. And given that currently the price of Bitcoin is over $60,000, that still sounds pretty good. So their direct cost to mine each Bitcoin is less than half the market value of Bitcoin. However, it's important to note that this direct cost of Bitcoin is basically just the electricity cost and the direct cost of operating their facilities. It does not include depreciation, which is a huge expense. Because as Ryan said, the average useful life of the mining rigs is only 3 years. Every 3 years, you have to replace all of your mining rigs, which is a huge expense. And if you include that depreciation, the cost per Bitcoin is actually a lot higher. So this $25,000 is only the direct cost, that's a very important distinction to understand. And in the case of Riot platforms, they indeed have among one of the lowest, it might even be the lowest direct cost per Bitcoin of the entire industry. And the reason why Riot was able to get their direct costs so low is they have something set up with their utility providers where they agree that during times of, when the local community, the local area, electricity demand is high, Riot agrees to voluntarily pause its production to decrease the strain on the electrical grid. So in return for doing this, the electrical grid gives Riot power curtailment credits. So Riot agrees to curtail its power usage during times of high demand, and then the electricity grid, the utility company, gives them this credit, which they can use, basically decreasing their power bill. So in the second quarter of 2024, Riot platforms recognized $35 million of cost of goods sold in their Bitcoin mining segment. And this $35 million is mostly electricity expense. But then they also received $14 million of power curtailment credits. How they calculate their direct cost per Bitcoin, this $25,000, this is including the benefit of the power curtailment credits. So by having the system set up where they indeed get these $14 million of power curtailment credits, that's what allows them to have such a low cost per Bitcoin at only $25,000. Of course, the downside to this is that about half of the time, their mining rigs are not operating. So if we look at here, this blue line represents the total deployed hash rate that Riot has. So this is all of the mining rigs that they have in their facilities. If they were operating 100% of the time, this blue line is the hash rate that Riot would generate. But given that they are shutting down their production based on electricity demand, they only are operating their mining rigs about half of the time. So if we look at the amount of if we look at their deployed hash rate, but then adjust that for how often it's actually being used, it decreases down to this orange line which is way less. And that is basically showing that they're not generating as much Bitcoin as they could because they are agreeing to shut down production when electricity demand is high. And this means that for a given amount of Bitcoin that they want to mine per month, they have to buy way more mining rigs than they would have had they been operating at 100% capacity. So they have to buy a huge number of rigs, and then those rigs depreciate. So that creates a huge depreciation expense. And then they're not even generating that many Bitcoin because they're curtailing their power consumption so often. So while Riot indeed has a very low direct cost per Bitcoin, their depreciation expense is huge because of this type of strategy that they operate. So what does this mean for Riot's unit economics? So in June of 2024, Riot says that their average operating hash rate was 11.4 EHS. And this is the average operating hash rate. So this is already adjusted for the fact that they're not, this is already adjusted for the utilization rate. And in that month, they mined 255 Bitcoins. So if you just divide those two numbers, you get 22 Bitcoins per EHS in the month of June. And if we multiply that by 3, we can get that it would, at this run rate, they would be generating 66 Bitcoins per EHS per quarter. And EHS is exahash per second. That's just a unit of measurement for hash rate. So in the second quarter, they had their direct cost per EHS was $2.2 million. And this is net of power curtailment credits. So if we take their June run rate of 66 Bitcoins per quarter per EHS, and we look at compare that to the $2.2 million of direct cost per EHS, that is a direct cost per Bitcoin of 33,500. Now, if you remember a couple slides back, they said that their direct cost per Bitcoin was $25,000. Well, that's true, but this is for the second quarter. This is the average for the entire second quarter. The halving event only happened in April. So the second quarter doesn't have the entire effect of the halving because it happened, I think, like April 19th or April 20th. So for the first 3 weeks of April, they were generating way more Bitcoins because that was before the halving event. The number of Bitcoins they generated decreased in May and June because this is after the halving event. So and as the number of Bitcoins that they generate decreases, the cost per Bitcoin increases. So that's why the June run rate is way worse than the Q2 average. And yeah, as of June, their direct cost per Bitcoin was probably about 33,500. Now you might say, well, that's still fine because the current price of Bitcoin is more than 60,000. So their direct cost is still way lower than the market value of Bitcoin. Well, that's true, but we also have to consider Riot's corporate overhead. And if we include Riot's corporate overhead, their cost per Bitcoin, including corporate overhead, is more than 100,000 per Bitcoin, which is way higher than the current Bitcoin price. And that's another problem with Riot's strategy of doing the power curtailment, is because in order to mine a given amount of Bitcoin, they have to have huge operations, huge numbers of mining rigs, which has huge operational complexity. And then they're not even being operated all the time, so that their administrative and corporate overhead costs are basically divided across a smaller number of Bitcoins because their utilization is so low. And so that has given them a very large SG&A allocation per Bitcoin, which is one of the reasons why they're unprofitable. So Riot says that they plan to massively increase their hash rates over the coming years. So currently, as of the second quarter of 2024, they had 22 EHS of deployed hash rate. And they say that by 2027, they're going to increase this all the way to 100 EHS. And a lot of investors are bullish on some of these Bitcoin mining stocks because they see these projections and say, oh, this company, they're going to massively increase their deployed hash rate, and that's going to allow them to mine more Bitcoins, which will be a good thing. The problem is when basically all of the Bitcoin miners are doing the same thing, trying to expand and expanding the hash rate, all that's going to do is push the difficulty rate higher and higher. So it becomes more competitive. So even if if you're a Bitcoin miner, even if you massively increase your own hash rate, if all your competitors are increasing their hash rate at the same rate, then you're not even going to generate more Bitcoin because the difficulty rate is going to increase commensurately. And historically, pretty much all of the publicly traded Bitcoin miners, including Riot, have had a negative free cash flow and have relied primarily on dilutive equity raises to fund their operations and fund their expansion plans. In the case of Riot, if we look at over the past year, their number of shares outstanding was about 160 million in the first quarter of 2023. As of July of 2024, this has increased to almost 300 million. So over the past year and a half, the shares outstanding has increased by something like 70, 80%. And they would say, okay, we're raising all this capital, issuing new shares to raise capital, and we're going to use this money to expand our operations so that we can mine more Bitcoin. The problem is that as they have indeed been expanding their hash rate, the entire network has been getting more competitive because all of their competitors are doing the same thing. So the difficulty rate is increasing extremely quickly. And during this period, Riot's Bitcoin mined per quarter has actually been declining. And declining, in the first quarter of 2023, they mined more than 2,000 Bitcoins. In the second quarter of 2024, they mined only about, I think, like 800 or 900 Bitcoins. So the number of Bitcoins mined, their rates of how many Bitcoins they mine each quarter has actually been cut in half during this period where they did, massive investments and did a huge number of equity capital raises. So it's the purpose of including this chart is to show that, all these Bitcoin miners, they're raising capital saying that, oh, we're going to, use this money to expand our operations. But given the realities of how the network difficulty is increasing so quickly, despite them, investing for growth, their, number of Bitcoins produced may actually be declining. And that's something you have to be aware of.
So some people might say, despite all this, like in the past year and a half, the price of Bitcoin has increased by $40,000, right? It's pretty much tripled in the past year and a half. What if the same thing happens over the next year and a half? Like, what if the price of Bitcoin continues to increase by another 40,000 and goes to $100,000 per Bitcoin? Shouldn't that be good for the Bitcoin miners?
Yes, it'll be good for the Bitcoin miners, but you also have to consider the alternatives that as an investor, say you're bullish on Bitcoin, you have a few options. You could invest in these Bitcoin mining stocks, or you could just buy Bitcoin directly. And at least in my opinion, you're almost always better. You'll almost certainly be better off in the long run if you just buy Bitcoin directly, because these Bitcoin miners, even if, let's say, if the price of Bitcoin increases a lot, well, in the short term, the miners will become more profitable in USD terms because they're making more money per each Bitcoin. But that will cause more miners to enter the industry, and then the network difficulty will accelerate. The Bitcoin price has already increased massively, like over the past 5-10 years, but Bitcoin miners are still losing money because of the structure of the industry and the fact that the difficulty rate is increasing in tandem with the Bitcoin price. So why would you expect anything to change going forward? Even if the Bitcoin price continues to increase exponentially, well, the difficulty rate's also going to increase exponentially. And then, if the Bitcoin miners are losing money now, why would that change in the future? Is the point I'm trying to make.
So basically, it's like a negative feedback loop that keeps them unprofitable.
Yeah.
The other thing that I've seen Bitcoin mining bulls and Bitcoin miners say is that even if they can't mine Bitcoin profitably, they could just repurpose their facilities to AI data centers, right? AI seems to be the new biggest thing now. And a lot of these Bitcoin miners, they have the warehouses set up, they have the power hookups to the grid, they have some level of internet connectivity. So doesn't that de-risk the Bitcoin miners, even if the mining itself can't be profitable?
I'm a bit skeptical of that for a couple reasons. So as Ryan talked about earlier, the mining rigs are application-specific integrated circuits, so they can only be used for Bitcoin mining. So the current mining rigs that they own cannot be used for AI. So if you're a Bitcoin miner and you want to make an AI data center, you're going to have to buy completely new hardware to do that. And you might say, okay, well, you can buy the new hardware, but at least you have the warehouse and the electricity connections and such, which is true. But you also are going to need to build new expertise in terms of how to operate an AI data center, because an AI data center, in terms of maintenance, in terms of how you operate it, is very different than a Bitcoin mining operation. And if you are going to be entering, trying to make an AI data center, you're competing with the large established cloud service providers like Microsoft, Google, and Amazon, which are trillion-dollar companies that have huge economies of scale and huge amounts of expertise. And if you're one of these, Bitcoin miners just trying to break into the industry, I think it could be, I think it could be maybe more difficult than people think. Now, there are a few Bitcoin miners, I think, that have said that they plan to transition into the AI data center industry, but I think thus far they've had kind of mixed results. But that's something definitely we need to keep an eye on going forward. But I personally am a bit skeptical that this AI data center business is really going to be viable for these Bitcoin miners. Well, I think that's about everything we had to talk about Bitcoin miners today. As always, if anybody has any thoughts or opinions, please feel free to let us know in the comment section below. And we will see you all on next week's video.